Hi everyone, welcome back to Be Rich. I hope you had a wonderful weekend. Yes, the last week of October is upon us. By the time this week is over, we will be well into November. And what do we have in terms of news? Well, in terms of news, like I said in my Instagram handle before the weekend started, on Saturday, I think, the FIIs are exiting India in rapid, quick tick, as they say. We have already crossed 1 lakh crore worth of sale in India. The FIIs have pulled out funds, and it seems to be most of that funds has gone to China. At least 85,000 crores has gone to China. And the reason is very apparent and it's very obvious. If you were an FII, you would be doing much the same. Like I've been saying many times, FII's investment ideology and their motivations and their gameplay in India is very different from than ours. We are value investors. We're trying to build wealth. We're trying to invest over the long term. FIIs are not doing that. They're not here for the long term. They're not here to invest and hold and see value stocks. They'll try and buy things at a lower price and look at the earnings and see if it's going to go up within a year or two. Hold on till that point of time and exit those stocks. And they need to keep looking at value everywhere, wherever they go around the world. Like I said many times, they have, let's say, a wealth fund or a pension fund, and these guys have certain targets to meet because payouts need to be made. So they take a certain percentage out of that. Most of it will be in very safe, secure things like treasury bills in the US or, very safe securities. And they take a little bit of it, a small percentage of it, and they take it and they play in international markets around the world and try to leverage that and gain very good returns to make sure they can make these payments which they need to make. So based on that, they were in India. They'd invested heavily in India for the simple reason post-COVID, China was not looking appealing. So they've been sitting in India. And that's why one of the main reasons why our stock market has gotten so overvalued. Because the FIIs have been pumping money in, the DIIs have been pumping money in, both people have been putting a lot of money in. So there seems to be no break, and it's been pushing all our valuations sky high. Now the FIIs have decided to exit. Fortunately for us Indians, we've been looking at the stock market over the last few years since post-COVID and thinking that, oh my God, instead of keeping all our money in FDs, keeping it in the stock market will give us better returns. And lots of us have been opening up mutual funds and sipping accounts and been sipping into the stock market rather than keeping FDs. And this is also spoken about, and the RBI has spoken about it, and many articles have been written about it, how banks are finding it hard to retain deposits because we're getting better returns and we're not beating inflation with FDs. So as the FIIs are exiting, us DIIs are buying. Now the curious case becomes when us DIIs are expecting certain kind of returns from our investment in the mutual fund house, and we don't see those funds giving those kind of returns, there might come a time when us DIIs also might feel that it is better to keep the money in FDs or in the bank because there's not much return coming in the stock market, because we've been seeing FIIs and DIIs playing off each other, pushing valuations sky high. So we've been seeing these returns, stellar returns as they say, even in junk stock, even in micro caps, even in small caps. We've been seeing these kind of returns and we've been feeling very excited about it. That may not come out now. So you may see if FIIs decide to stay out for some time and they don't reverse their position, because as it stands, China seems to be their place and their destination. And there's no reason for them to reverse and come back to India right now because the valuations are not going any further down to the point where we were what China was, attracting them back to our shores. So at that position, what will happen is DIIs may not see the returns in a year's time. So from today onwards, your portfolio in your mutual funds may not see the return it saw a year or two ago. And then you may be thinking, maybe I should not be sitting inside a stock market. Maybe I should buy gold because gold seems to be the place to be now. As Shashwat spoke in the video, Anand has spoken in many videos, a lot of people are thinking of placing a hedge on gold. So if you have a lot of money lying on the table, you may put it in gold and may see some great returns because gold is expected to go to 3,500, 3,700 by end of next year. That's what a lot of people are speculating on that. It may not, it may, I don't know. No, I'm not a fortune teller. But so given all that into take, a lot of funds may leave the mutual funds. People might pull it out because they don't see the returns happening in a year or two. And if that happens, trust me, all bets are off where the stock market, Indian stock market, can go and finally settle down to. I'm not trying to do doomsday here. The reason why I'm laying it out like this is because a lot of you keep asking, when are we going to see these huge corrections? When are we going to see the huge corrections? This is not a big correction. It's only 8%, 9%. You said 30%, 40%. Yes. So keep an eye out. If no one could predict this, what the FIS were planning to do, no one could predict that China was going to turn around and start paying attention to the domestic economy, and because Xi Jinping didn't seem to be very interested in it. And I don't know how interested he is still, because we actually have to see these things take into motion and come into fruition in China for these bets to be made there. Anyway, so this is all what's happening over the weekend, what I was thinking about, which I've been sharing with you in our 52-week challenge group in Instagram and on my Instagram stories. I've been having conversations with many of you about this. So there, I wanted to get this bit out. Now, the second half of the video is coming to the split of Dr. Reddy. It's finally happened. The split has happened, and now Dr. Reddy has settled down in a sweet spot of 1,315 as I'm recording. It was negative in the morning as I started recording. Now it's turned to a positive. It's almost up 1%. And those of you who did follow me on Instagram would have seen on the 52-week challenge group, I'd put up Dr. Reddy's negative opening and Natco's negative opening, both side by side. They both almost touch and go near the same price. And I was asking you, what would you do? Would you rather take Reddy now? Or would you stay with Natco? Because there is more here than just PE, I guess. Because Dr. Reddy is a much larger company and a much bigger fish. It's a whale compared to Natco. Dr. Reddy's market capitalization is 1,09,722 crores, while Natco's market cap is at 23,430. They're almost more than 4 times the size of Natco, right? Natco's PE is 14.3, while Dr. Reddy's right now is settled at 19.7. And if you look at price to book, Dr. Reddy's at 3.8, Natco's at 3.9. EPS growth of Natco is 50% for the last 3 years. Dr. Reddy's over the last 3 years has been 41. So it's pretty much all close together. So then what do? Do you bet on Natco or do you bet on Dr. Reddy? Well, me personally, I am looking at Dr. Reddy very happily because I have a bias towards Dr. Reddy, because it's one of those companies my father had initially, when the IPO had come way back, had put the IPO, and it's there in our family holdings, like Anand has said, mentioned it many times. So when I see Dr. Reddy at this kind of a point where I can touch and reach it, it is in my tiffin coffee range. I'm not saying it's in everybody's tiffin coffee range. 1,300 rupees is a lot for a tiffin coffee for a lot of people who watch this channel and watch our sister channels. So I get that. But it is still almost in touching distance for some of you. For many of you like me, it is in touching distance. So that all things considered, I don't know. Because if I look at the dividend yield at least, Dr. Reddy gives a dividend yield of 3% and Natco hardly comes to 1%, it's 0.73. So if I'm looking at putting capital, I would have a long, hard look at this. So this is what I wanted to leave out there and ask you guys to consider, Dr. Reddy or Natco. I want you guys to put it down in the comments like I asked in the 52-week challenge. What is your proposition? What do you think you should do? And let's have a conversation about this in the comments, and come and catch me on the 52-week challenge, where I'm more actively talking on one-on-one. I don't talk in the YouTube comment section because of all the bots and all the noise. I try and refrain from that. I try to actually have conversations with actual people. That is what the point of the 52-week challenge group is, where I've opened up these conversations and I'm trying to talk to each one of you there. I personally, like I said, I'm very happy with Dr. Reddy where it is, and I will be consuming more of Dr. Reddy as it goes. I do think both are great companies. I will get my brother in and get his opinion on this. I'm sure his opinion will be varied from mine, or maybe similar to mine. And I'm sure you guys value his opinion far more than mine, which rightly you should, because he's the one who's far more seasoned than I am when it comes to this. I'm more like you guys, so that's why I get excited the way I see the prices. So anyway, I hope you found this video informative and entertaining as always. Do put it down in the comments like I asked, Natco or Dr. Reddy, which way would you be leaning towards? And let's get this conversation going. And maybe I'll get Shashwat in to do a follow-up video on Dr. Reddy and Natco and compare it more in detail, in depth, if this is something you guys would be interested in. Do have a wonderful week ahead, the last few days. Those of you who celebrate Halloween, I hope you had a wonderful Halloween. Those of you who did it in the weekend, the actual Halloween date is coming up too. Next will be Thanksgiving for those of you in the US who are looking forward to it. And for Indians as here, we have Diwali happening. There's lots of memes are going around about Diwali and Thanksgiving landing together. It's quite funny seeing the cultural mix, the potpourri of Indian culture and American culture when it comes to this holiday. Do stay safe out there, and I'll see you again soon. Thank you once again.
Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.